Alright, day 14 of the 21 days property investment course. Today we're talking about interest only loans and working with professionals. So I get a lot of questions, I have in the past when I've been doing calls about interest only loans and if there's any dangers of using interest only, and why not paying off debt using interest only loans is something that people do. So an interest only loan is, instead of paying down your mortgage over a 30-year term and every repayment your mortgage gets smaller, an interest only term is when you get charged interest on the money you've borrowed and you only pay off the interest, you're not paying off the debt. So it's very common for property investors to use interest only loans, and you'll see why. So principal and interest is P&I terms is used for family homes typically in New Zealand. So your first mortgage generally will be principal and interest, they'll be on your family home, and you'd only have one principal and interest mortgage at any time, usually the property that's getting the highest capital gains or the family home, and you would use interest only loans on your investment properties. There are some investors that don't do it that way, but it is, based on the spreadsheets, very typical for investors to use interest only, because the interest only allows you to borrow more and it allows for a better cash flow. And having the better cash flow, it gives you more options. When you're an investor, you want to protect against the downside and maximize your options. So if you, instead of committing yourself to paying off a mortgage as fast as possible, you can still pay the mortgage off fast, but if you give yourself the option of going a bit slower because life happens, then that's what interest only allows for. So to summarize, interest only increases your cash flow, allows you to borrow more, it's more tax efficient, and it increases your options as an investor. So let's have a look at some of the numbers. So let's say you're going to buy an investment property for $800,000 and you're going to get $700 a week rent for that property. Now, just using today's rate that I saw on ASB, the 1 year rate, if you were paying 4.19% on principal and interest over 30 years for the full $800,000, the mortgage is going to cost you $901.50 a week. So you can see that there's negative cash flow when you have principal and interest mortgage of more than $200 a week, and that's not including rates, insurance, property management, maintenance, things like that. So if you bought that property and you used an interest only loan, then using the same rate, the same 12 months fixed, then your total mortgage repayment on interest only is going to be $645. So you can see that there's more than $250 difference because we're not paying down principal, we're only paying on the interest portion, and we're creating a surplus that we can use to pay for maintenance, property management, insurance, and hopefully there'll be a little surplus at the end of the year, a couple $1,000. You can use that to pay off your own mortgage, pay down debt on this property, you can reinvest it in more property. It gives you options. So you can still, if you want, put the surplus money back into principal, which is what would have happened in this scenario, or you can do other things. And so principal and interest is not desirable for investment properties unless you really understand the risks along with it. So as a member of the public, the thing that you really need to understand is each bank has different policies around interest only lending in terms of terms, in terms of options for borrowing that money. And if you don't understand the policy changes and what's going on with each bank, it's very hard to keep up. So you really want a mortgage advisor, or at least a couple of different bankers from different places, to give you insight on what options you've got based on your age, your income, your investment level. And you got to keep that mindset that paying down your mortgage debt is conceding that there's no other better investments, no other better return on cash. Paying down mortgage debt is not the goal. The goal is building financial freedom with a lot of passive income, and if you choose to put that surplus income into paying down debt, that's great, but don't be afraid to have only the family home on principal and interest and have everything else on interest only. And 24% of the lending in New Zealand, last time I checked, is interest-only loans. There's a lot of investors borrowing money in New Zealand, and they use interest-only loans strategically, 5, 10, 15-year periods, and then they either sell or start paying down the debt. And when it comes to lawyers, accountants, mortgage advisors, just take the mentality of you wouldn't be doing your own fillings, you wouldn't be pulling your own teeth. You go to the dentist when you need a dentist. Why would you try and do that stuff yourself? And you should have the same mentality when it comes to tax, finance, anything accounting or legal related. You're going to go to professionals, and it's the same with mortgages. There's a lot of nuance with all of this stuff, so just find people you trust, and trust again in the spreadsheets when it comes to interest only loans. Any questions? Let us know.